Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of the video, I've got 3 additional trade ideas to share with you, so make sure to stay tuned for that. Let's kick off the S&P analysis here with our sectors, who was leading, who was losing, and where was the weight. The XLV for the healthcare sector led the pack today, up 0.87%, whereas down at the bottom of the barrel, we see the XLE for the energy sector down 3.48%. That's as measured from the prior day's close. From today's open, it's actually even worse, down 4.8%. As we know, though, the energy sector is defensive in nature, and it's actually a good thing to see it coming in. We know that energy is coming in because crude's coming in, which relieves pressure on the market overall, right? So this is a good look to see that at the bottom of the list. And the XLV, second heaviest weight by market cap technically, is up there leading the charge, pulling its weight. So that's also a decent look to see that one leading the charge, leading the pack on today's session. In terms of the other heavier weighted sectors, the XLK is the heaviest of them all. That's the tech sector, up 0.2% on today's session. The XLF is the second heaviest weighted sector that we're watching. That was actually down 0.56% on today's session. And then, of course, the XLV, second by market cap, third on our list. We already covered they were up 0.87% on today's session. Let's quickly take a look through some of these sector charts and talk about the rotation that's happening here into healthcare. Okay, so we had this balance area, monthly balance area, really just a sideways area on the chart. And what you'll notice is that we broke below. There was the possibility for a break, retest, and then failure, right? Something that would have looked like this, but now we are definitely getting some more further acceptance inside and above the bottom end of the range at 125. So I like the look that's developing here inside of healthcare. We know that technically speaking, even on the worst of pullbacks, as long as we hold above 125 for a higher low from here to here, we're all good from a structural standpoint inside of the healthcare sector. Now, again, thinking back to the rotations here, you can see clearly that there have been a number of really large consecutive up days inside of the healthcare sector. So if this does want to pull back, I would just be mindful that if the rest of the heavier weighted sectors are not pulling their weight for that given day, aka tomorrow, Thursday, and Friday's session, then this will be bearish drag for the S&P 500 in mass, right? Remember that just because one of the heavier weighted sectors is, pulling its weight to the upside doesn't mean that if it pulls back and the others don't step up, it won't cause a pullback in the S&P 500 itself. So hopefully that made sense. Basically, the main takeaway from this chart is that even if this pulls back from a structural standpoint, it's okay as long as we're above 125. But if this pullback occurs in the remainder of the week and the remaining heavy weighted sectors, the XLK, the XLF, and the XLY are not pulling their weight, you're going to have a down day in the S&P 500, okay? That's what I'm getting at here in the XLV. I think this will be a critical sector to watch into the remainder of the week, right? Can we maintain a little bit of bull flag consolidation and breakout to get into these highs here, creating equal highs, and then potentially affording the next higher low pullback? That's the objective inside of the XLV chart. Continuing along to consumer staples, what's going on in the XLP? Similar, right? There has been some relative strength here, but nonetheless, this isn't a heavier weighted sector that's really influencing the market as much as the XLV per se. Notice that we have a small consolidation doji here as opposed to the more bullish candle that we printed in the XLV itself. Zooming in just a little bit, if this were to break down, again, it's okay if we pull back a little bit further. This one wants to form a higher low above 70 overall, just kind of as long as we don't come back down into these lows. I would start to say, though, if we take out the Fibonacci's and come in from the lows up to the highs, we really don't want to be underneath the 50% fib. So let's actually bump that number up to 70, 75. As long as the pullback happens to there and then reverses for a higher low, I would say structurally speaking, there are some improvements here, but do also remember that consumer staples are, in fact, a defensive sector by nature, right? So as long as they're not leading the charge up here, that's fine. But on a relative basis, we also don't want them leading the reversal back to the upside. So watching for consolidation, really a sideways look in here would be decent for the XLP. And with the little consolidation doji we saw in the lower third of the breakdown bar, lower half of the breakdown bar, to me, that would sort of align with what we just said, a little bit more neutral here in the XLP. Continuing along. Communications, what's going on in the XLC? This one is a little bit more concerning, right? We had this range right up here. We've gotten a break, retest, and failure now. And also, today's bar actually broke back down underneath the dead cat bounce highs, right? So this sort of dead cat bounce, I suppose that was ultimately the highs in there. But we're really even underneath these 3-day breakout points as well. So I'm really kind of not liking the idea that communications are doing anything bullish for the marketplace right now. Now, sure, we did print a dragonfly doji, a hammer, if you will. And if we take out the high, maybe we revisit that 5640. But overall, this is not a good look for a better reversal in the S&P 500. This strikes me as a more bearish chart compared to everything we've seen so far in the XLP and the XLV. Perhaps the most important, the XLK, the tech sector, right? What's going on from this perspective? Sure, there is the possibility for a lower high here. We rejected right at the gap. We'll see that on the Qs as well. But look at what's the difference is, right? This has not given us a break, retest, and failure. Instead, we did technically come back up inside of and above this set of highs in here, and we have a consolidation sort of doji right at the back test of the level instead of exploring more firmly underneath like what we just saw inside of communication. So although this isn't the best look, again, the XLV, the XLP look far better than this chart that we're looking at on the XLK from a structural perspective. I would say if we reverse out of this and come into the bottom of the gap again, that would be the bullish look for this particular sector, noting that we would have low, higher low, and we're coming in for that equal high. Can we break it, fill the gap, form a higher high, and then afford the next higher low pullback, right? That's the bullish objective of the chart. If you're a bear here inside of the tech sector, inside the marketplace as a whole, you would want to see this underneath 128.40, okay? If we drop back down underneath, lower high, and I would say, again, if we fail this level, we're coming in for the equal low here, much closer to 123. Obvious bearish drag for the S&P 500 as a whole. XLU utilities, not going to read into this too much. Remember that it is defensive, big bullish move, kind of sitting up here sideways in consolidation in a bull flag. If we think about it from a Fibonacci perspective, if my eyeballs serve me right, we're about 50% of the way home. So this is not as bearish as it could be if we were to have rejected at the 38.2. Let's actually check my accuracy here. Pretty darn good if I don't say myself. So rejecting the 50, if it falls back down underneath the 38.2, that's a better look. If it wants to consolidate here and break out and recapture the 61.8, that starts to become concerning for more of these defensive names signaling more risk off in the future, right? If we take out that 61.8 here and the remainder of the risk on sectors, the XLK, the XLV, the XLF, right? If those aren't perking up and this recaptures 61.8 here in the XLU, not a good look. And that number, the hard number, by the way, is $71 per share of the XLU. Let's continue along and get into the XLY. Consumer discretionary, again, a little bit more of a concerning look here, noting that we're back down underneath this set of levels, highs, in here. So here was your dead cat bounce, right? Boom, we wanted to kind of consolidate above that. A lot of damage was done on that Tuesday fall apart where the market was just kind of in free fall mode to the downside. Notice that we just have a little consolidation acceptance doji inside of this area instead of strongly rallying back up towards that breakdown area, right? Or even just the highs in here. There was virtually no rally or relief from the selling pressure that we've seen. So this is obviously falling much more firmly into the bearish camp in today's sort of analysis of the data points, if you will. So XLY has some work to do. If it's going to be bullish into the remainder of the week, we've got to get back above that 143 level. Anything that continues to consolidate in here strikes me as bearish, noting that the next likely move in a downtrend would be breaking support around 136, right? So that's kind of the levels and thought process in the XLY. XLF, financials, second heaviest weighted sector that we're watching, another sort of disappointing look on the chart itself. If we zoom in a little bit from the structural perspective, here was that critical backtest area. We technically opened up above that on the Tuesday session. And then we fell. Obviously, again, the full breakdown across the entire marketplace had a lot to do with that. But nonetheless, the fact that we could not stay above this level strikes me as the concern from a structural perspective. It looks to me like we're building out a clear lower high and also a break retest coming back in for those equal lows here around 31. So again, another bearish data point here for the S&P markets as a whole. Notice that today's candle was actually just a bearish sort of acceptance and continuation move lower after the breakdown. There was a little bit of follow through on slightly higher volume. So again, falls into the bear category. XLI for industrial is not going to spend too much time here. Overall, it's got to bounce and sort of get back up to this inverted head and shoulders neckline. Otherwise, it's going to produce a little bit more bearish drag for the S&Ps as a whole. Lightweight sector, again, so we'll just move along here. Real estate, same sort of idea. It did produce a lower high from here to here, filled the gap and rejected off of it. Hammer candle, interestingly though, is above this breakout point around 40.25. So that's got to hold here. And at least, something in here is neutral consolidation. Breakouts back above 42 is bullish. Breakdowns here bearish. But remember, lightweight sector, it's not going to save the day if the rest of the market's falling apart and real estate is rallying. Taking a look at the XLB for materials, again, lightweight sector, not going to spend a whole ton of time. It's got to get back up and over 76.50 to be bullish on this and start retracing through some of the thin structure as it just kind of remains down here. Neutral to bearish, right? Obviously looking more like a bear flag, something of this sort. Breakdowns of 73 roughly. Continue this to the downside. Then last but not least, the energy sector, right? So this is the one that we were discussing was a decent look, seeing the big down day here and the relief of the pressure in the crude markets. But again, it's only going to do so much. The rest of the sectors do ultimately have to pull their weight to the upside. But to see this coming in is a good sign. Remember that ultimately speaking, from the top to the bottom, as long as this is underneath the 38.2, I would say that the bears remain in control on this pullback. We ultimately did have that 100% retracement. So any dead cat bounces here that happen below the 38.2, aka this boom, little move that I just drew in as the uptick, that fall back down to this base, and here the 100% retracement, continue to mean, okay, bears are kind of in control. Sellers are in control here in the energy sector, which through inverse thinking, right, is actually a decent thing for the S&P 500 as a whole, okay? So, and again, don't get me wrong, it's good from a relative strength, relative weakness, risk on, risk off perspective. Obviously, downward pressure is still downward pressure for the S&P 500. People always get hung up on that. I just want to be abundantly clear about that. It's nice to see this not leading the charge. It's nice to see it coming in. But ultimately, yes, if energy has a massive down day, right, it's going to put a little bit of bearish drag on the SPY itself. So hopefully that's clarified that. Those are my thoughts in the sectors themselves. Let's take a quick peek at the ratio grids and see if risk on is signaling yet. And unfortunately, not really, right? So the big four at the top are our risk on sectors. Notice that the XLK, it was perking up. It was looking so good, and now it's just kind of back down underneath that 50 SMA. It's not down at the lows, so I will give it that. Credit where credit is due always, but it's not as good as it could have been if we just continued a little bit higher here to kind of break more firmly this, oops, that's kind of a crappy drawing, but the descending triangle look, right? So overall, watching to see if this wants to perk back up. It's trying to. I would say it's much more neutral, going sideways here instead of just clearly to the downside over the past couple of weeks. But, you know, it's really got to show and prove and give us that higher high before we start getting interested in more of a risk-on look. No doubt about healthcare remaining that number one sector where the rotation's happening right now. Chart is incredibly bullish to the upside, massive distance to the 50 SMA there, even in such a glaring uptrend, right? So great relative strength in the healthcare sector, but unfortunately, 1 of 4 is not enough. Notice that your XLY is going sideways to slightly lower, still underneath the descending 50 SMA. Same thing in the XLF financials. Sure, it perked up off the lows a little bit, but already rolling back over here for potentially another lower high. So not a great look. 1 of 4 is not enough to turn risk on. And down at the bottom, to turn risk off, we would have to see at least 2 or 3 of these pointing in the downward direction aggressively. XLP, still solid. Energy, obviously we talked about it coming in, so this is the start of a good look, but 1 of 4 isn't enough. Notice that utilities still look fine here, and the XLRE for real estate is really just going sideways, much more neutral. Risk off is still the case based on our relative strength ratio grid here for our S&P sectors. Let's rewind the clock just a little bit, not rewind the clock, but rather just go back on over to the charts and take a quick peek at the TNX. While we were talking about financial things, this is usually where we throw this one in. So the TNX is our 10-year treasury, right? This is the 10-year interest rate. What's going on? So kind of getting back down closer to that 31 and 30, and that's ultimately 3 and 3.1 in the interest rate itself. And it was a good thing to see this really cool off and go sideways in here. We wanted to avoid another sharp rally to the upside like what we saw in here. So the fact that this is stabilizing strikes me as a good thing. Now, with the inflation numbers, PCE coming out tomorrow morning, I'm not sure how interest rates will react to that, right? Obviously, if the interest rates are, if the PCE comes in hotter than expected, which it very may well could, then there's a possibility that interest rates respond by forecasting that the Fed might continue with another 75 basis point rate hike the next FOMC meeting, right? So that's the concern in the TNX. And obviously that's downward pressure, right? If this makes a rally back higher, that's downward pressure for the XLK, bearish for the S&P 500. The next thing that we're usually looking at for the behind-the-scenes look is the VIX. What's going on with volatility. Notice that we're still in the box of wickedness. We have not made the leg lower. And we also, interestingly enough, although on the Tuesday session it felt like all-out free fall, notice what the VIX did. It didn't even spike up close to the top of the box, never mind that 40 number, the 40 handle up at the top. Right? So VIX still signaling to me at least that there's still a lot of uncertainty in this marketplace, and we have not yet seen that capitulation bottom, right? This is just a clear and glaring indication of that on a day that was nasty, outright nasty in the S&P 500, right? Down over 130 points in the ES futures. Why was the VIX only up nominally about a point, one handle here to the upside? So overall, I think the VIX is still signaling that something's not quite right about this being a true bottom just yet. Let's take a quick peek one more step behind the scenes. So VVIX. What's going on in the volatility of the volatility index. And this once again has dramatically collapsed underneath the 103 mark, which would just be an indication that no one is hedging in the VIX. No one's buying VIX calls. Therefore, when and if a market collapse sort of does come, it's going to come hard. It's going to come hot and heavy. It's not going to be pretty because no one's kind of prepared for it. So you get this big spiral as everyone's buying puts, everyone's buying VIX calls. The market kind of moves even faster when no one's prepared for it. Whereas if you had decent hedging activity, we were more up here, that could be sort of combated by some of the people who were already prepared and not the mad dash into SPY puts and VIX calls, right? So that's what I've got for you in the behind the scenes look. Let's go ahead and take a quick peek now at our SPY itself. What are the levels? What are the numbers that we're actually concerned with into the remainder of the week? So zooming in, you'll notice that we have a blue line on our charts. That's going to represent the thin structure from the Friday rally there. That's really, if we take a look over here, this is an hourly chart. We're usually looking at a 30-minute chart, but it's fine. I'm not going to switch it for now. That was where we had the consolidation and thin structure existed underneath. That was wiped away in the big breakdown from the Tuesday session. So if we remain underneath 386, ultimately, it's bearish in the S&P 500. Everyone who got sucked in up here is a long with poor trade location. If they haven't closed out already, they're just waiting to do so at a better opportunity. It could come up here, sell for a lower high, and do something like that. So 386, if we're below that number in the S&Ps, I would continue to maintain a bearish stance. This, to me, would be a significant lower high here. From here, right, you get that sort of look, and we're probably coming back in for the equal low, closer to 364. This is if we fail at the 386 level, right? Now, we did produce a hammer candle, a small red hammer candle nonetheless, but a hammer, no doubt about it, off of the gap fill area here. So we did fill and repair that structure from the Friday gap up. And ultimately speaking, as long as we're above 378.72, I would sort of look for maybe even a little bit of a lift here over the high of today's session to get into that 386 and then use that as the judge, okay? So right now, strikes me as a pullback to fill the gap, repair the structure. If we take out the hammer high, that would be my look, and then seriously reevaluate the chart at 386. If we don't take out the hammer high and we just consolidate in here and break down, your next target underneath is 371, and that would also be breaching the weekly expected move here. Is that the end of the world? Not really, considering that the market has gotten it wrong now 3 weeks in a row. The market's not really efficient, so if this were to breach underneath and close below, wouldn't strike me as a concern really for overextension to the downside, right? On the upside, if we were to recapture 386 with some strength, the reason I'm saving this sort of bullish analysis for last is because we've looked at a number of, I would say, bearishly skewed data points so far, right? If this does recapture, though, it's all about the bottom of the gap. Can we actually make it there at 395.50? So that's your critical upside watch, and of course the resistance trend line. If it holds here for a higher low, again, it's got to get to the resistance trend line, then the next higher low pullback has to break it. Otherwise, to me, in the grand scheme of things, just not that strong of a market getting into that resistance trend line. So those are the numbers. That's sort of the psychology that I'm looking at in the S&P 500. Let's take a quick peek at our market internals. As this is loading up, I've got a tutorial video for you. It's in the top right-hand corner. If you don't know what this is or how to read it, how to set it up, that'll show you how to do it and how it'll help you make better intraday trading decisions. So what do we see inside of the internals? And again, I think this is pointing in the bearish direction. Notice that on this day, so Monday, flat, Tuesday, obviously pretty nasty. It didn't breach, though, like negative 600 million, like what we were seeing prior when we were seeing those really nasty outflows from the market. So it's not as bad as it could have been from a volume perspective, but usually using 300 million as a sort of threshold for significant. It was right there. It just wasn't outsized. It wasn't like a 2 standard deviation move there. And the same thing on today's session. Although the selling and the activity was predominantly sideways, the selling and the outflows from the market were just as serious as what we saw on the Tuesday session, right? If we look at the advanced decline lines, neutral, incredibly bearish wall to wall, and acceptance lower here just above the trend zone around that 1500 on today's session as we were going sideways. So the internals also skewing to the bear side here, even as we had a sideways day in the S&P 500. And of course, your tick builds neutral, bearish on the Tuesday, and really just more neutral on today's session, which is fine. Again, noting that we really just had more of a consolidation sideways day, not so much a trending day. So I think the market's kind of just getting bearish digestion of the breakdown that we saw on Tuesday based on what we're seeing here here inside of the internals. Let's take a quick peek at our market profile now. If you're not familiar with this software, again, I've got a video for you explaining what this is in the top right-hand corner. What do we see, right? So today's session was pretty compressed compared to the extreme expansion of range that we saw on the Tuesday session. So this is Tuesday, this is today, right? Notice a couple of things. We have a poor high and a poor low. So basically, it's very, very simple as we head into the Thursday session. If we take out the top, expect the poor high to be repaired, look for a little bit of a rally here. I would expect a move kind of maybe closer to here. That breakdown point, right, that could also be here. 38.75 is the level in the ES. That's the equivalent of the 386 level we saw in the SPY. So that would be the upside target if we repair the poor high and get a little bit of a squeeze higher. But again, use that as a serious judge when and if we get there in the first place. And to the downside, if we repair this poor low, big, 3 TPOs wide down at the bottom here, that's pretty ugly. If we repair that to the downside, what's the next look, right? So let's scrunch up the chart a little bit and see what we've got for points of controls. Virgin point of control right here. That's what I would be looking at, 37.80, right? So that would be this one, the untested point of control from 623, this session right here. So that would be my downside target, and that's really the main takeaways from the market profile. Again, if we get some sort of repair of the poor high, look for a retest of 37.75, or 38.75, excuse me, 38.75. And if we break down underneath this, it's 37.80 on the downside as your virgin point of control touch-up. All right, let's get back on over to the platform and round out the broad market. Thanks for sticking with me through it. What's going on in the QQQ? I think this has acted as what we've been calling it this in the Discord. The QQQ is the cowboy and the SPY is the horse, right? So you can clearly see the cowboy said, hey, hold your horses, easy does it at the resistance trend line. The horse, the SPY, pulled back as well based on the cowboy's commands. And essentially, just to keep it simple, we did not fill the overhead gap. Ooh, a little bit of lag here, sorry. We did not fill the overhead gap. We rejected at the resistance trend line. We filled the downside gap and actually closed and got acceptance underneath in the QQQ. So actually some relative weakness here in the Qs and tech. And remembering that this directly is going to correlate with your XLK, it's not the greatest look for the S&P 500. Now, we did print that hammer candle off the lows here and this level that we've had around 280.50. So if we can take out the highs, again, your look is to retest that blue line. That's the equivalent of the breakdown point here from Tuesday at 290.75 and the resistance trend line once again. If this is going to be a higher low pullback and reattempt the resistance trend line, it's got to break it this time around and it's got to come up and fill that gap all the way to really, shift the tone in a serious way for the market back to the upside. So those are the numbers, those are the psychology pieces. Because we're already sort of underneath the weekly expected move, again, I'm not sure it would be wise in the Qs because they're already there to initiate new shorts around this 280.50, but sideways consolidation here definitely sets up a bearish tone into the not the remainder of this week, but early next week, right? And of course, it will be a holiday trading week next week, shortened, so be mindful of that. But bearish consolidation Thursday, Friday here doesn't strike me as a healthy look as we approach the new week following, okay? So that's the QQQ. Those are the numbers in psychology. Let's take a quick peek at the IWM. Clearly see our downtrend is still intact here. We did not come up and fill that upside gap. We did not interact with the trend line. We are still underneath with some serious follow through here on today's session. That 173.75 level, that's the breakdown point from the thin structure on Friday. Everything about this chart strikes me as a little bit more amplified from everything else we've seen. So it's more bearish, right? It's definitely more bearish. Now we do have, again, that hammer candle, right? The lower wick that's supported off of 169, that level we've been talking about from here for quite some time. So if we take out the hammer highs, then maybe there's reason to believe it does something like this, but still you have that major hang up at 173.75, which would be just overhead, right? So the risk reward in the IWM is really not favorable as of right now, unless it were to take out the blue line. And given the current market circumstances, I'm not entirely sure that I would see that as a reasonable possibility into the remainder of the week. So IWM kind of more firmly falling into that risk off category. The one saving grace that you could say about the IWM is that its trend line is being respected here. So if we do something like this, obviously we got a little bit of a bounce off of that and we've closed as the hammer, right? That's that lower wick. But if this were to fail, obviously it just opens up the door for lower. So clearly in the IWM, again, more of a risk off indication. I would sort of look at this as much more of a neutral implication for the remainder of the market, the SPY and the Qs into the rest of the week. With that being said, let's dive into the core list of companies and finish up this video. Send you on your way with those last 3 trade ideas. What's going on in Apple? You can clearly see Very similar. Here is a level, right? Break, retest, kind of holding for now a decent look compared to some other things that we've seen. Notice the green bar instead of a hammer or just a small body doji down here. So a little bit of relative strength, but still rejecting at that 140 mark, which of course is a bearish implication. If we just quickly flip on over to the hourly and zoom in here, it is a pressure cooker top, and that's obviously where the breakdown stemmed from on the Tuesday session, but we were unable to close above it on today's session. So for me, that's the pivot, right? 139.85. If we can get back above, reason to lean on longs into the remainder of the week. If we remain below, kind of neutral in this zone, and then your next breakdown would be a failure back down underneath 137, probably to come back down into 135 on a day trade. After that, of course, your 130, 150 is the number. Next up, we've got Netflix. Going back on over to the daily time frame here, keeping it simple on Netflix. It's do or die at the trend line, right? So here's your trend line. We've already experienced a fake break of this ascending triangle, right? Here's your fake break, back down inside. So the trend line's got to hold. If we go through it sideways through time, not a good look. I would expect lower to fill up the triangle here into 165. That's bearish inside of Netflix. If it takes out the hammer high, it's got to get acceptance above 183. No questions about it. It's got to be above 183. And then the next bullish trade is a break of the 3-day highs, 50 SMA at 192.25 to rotate here 202.25. Okay. So current look hammer, yeah, it could save the day, but it's got to do it like now and no ifs, ands, or buts about it. So that's Netflix. Next up, we've got Tesla. What's going on in Tesla? This one's much more range bound and kind of getting difficult to trade in my estimation based on daily levels. If you think about where we're at in this range, we're near the midpoint. And what do we always say on the channel? Your edge really exists at the top of a range for a breakout or mean reversion, or the bottom for the same but opposite, right? Mean reversion or a breakdown. And being right at the midpoint is making this a little bit more wishy-washy, right? It's much harder to determine an overall trend here. We're not trending lower anymore. We're not trending higher anymore. We're just sideways. It's exactly that. Now, I would say, of course, that yes, this is a hammer candle. If we were to recapture 700, maybe we lean on longs because we're above the midpoint of the range. We're above that inflection point that we've been discussing now for quite some time. That would be your bullish move. And then if we reject there, so there's a tiny little bit of gap to fill there, but if we reject or open lower inside of range here on tomorrow's session, I would probably lean on short side or just avoid this in general, or just focus on 2 and 5 minute scalp patterns, not so much those larger follow through patterns, right? Midpoint of the range gets a little bit tricky to trade here, and that's where we're at inside of Tesla. Next up, we've got AMD. What's going on in AM Dizzle, as we've been calling it in the pre-market live streams. If you're not in those, feel free to join them. We do them every day, 8:30 is when they start. So bear flag, getting some breakdown here underneath the lows around 80.45. To me, bearish look, no doubt about it. Even if this hammer produces a little bit of a bounce because we've put in a new significant lower low, the trend clearly remains to the downside. We are now firmly once again back down underneath 85. A little bit tricky in here, but obviously now, much more firmly underneath with the confirmation breakdown of the bear flag here as well. So bears in control. Hammer might mean we sort of go sideways here, but if we can't really get back above 80.45, no reason to be thinking about longs inside of AMD. Even if we do, it's scalps only into 85, and if that happens, it's reassess the chart when and if we get there. Okay, but currently bearish look inside of AMD. Next up, we've got Meta, or old FB, as it was such. And this one actually looks, there was some relative strength there this morning. We saw that in the pre-market, but currently just kind of more sideways in the range here. Again, if you think about this exactly as what we just discussed inside of Tesla, it's kind of getting tricky, closing right at the midpoint of that little range that we've just drawn in here. I do think that there could be a bullish move up and over this level at 166.50 to get to the bottom of the gap once again. And that would really put into play a quite, it's quite sloppy, but it is there, an inverted head and shoulders. So here's kind of shoulder 1, head, shoulder 2. If we were to get there, again, that's kind of your neckline. Gap fill is probably the first trade. Then we have this thin structure to be trading for off to the left. One step at a time, don't get me wrong, but this could be spurred by a breakout up and over 166.50 on tomorrow's session. You can clearly see the importance of that level. So here you go, rejection, support after that big major rally, and then when the breakdown comes, we reject off of it on this morning's session. So that's what I've got for levels and sort of setup here inside of Meta. If it's downside, again, I'm not sure that I would look for shorts in here. Instead, it's got to be a breakdown under 160 to kind of get us down to that next level, the head of the pattern around 153. That would be a failure of the shoulder line, right? So that's how that trade would work out. Next up, we've got NVIDIA. What's going on here? Is it similar to AMD? Kinda, but a little bit more relative strength, I would say. If you look at the hammer candle, it's not clearly as far underneath of sort of this range right here, that bear flag, quote unquote, equivalent that we discussed in AMD. And I would say that this low actually cleaned up some of the weakness that we had from in here. So all of these were kind of on the money back to back. This actually poked a little bit further down. And I think if I go to the hourly again, Yeah, you can see it here. Notice this big lower wick. That's the proper end of an auction, right? So this could hold as a secure low now, and think of it as repairing this sort of area in here. So to me, the fact that it's closed right on the edge of the balance, right? If you look at the balance as this, or you could even draw it in as this, right? We closed right on the low of it. If we can get some acceptance back above 155.50, I would actually start looking for long opportunities inside of NVIDIA. Maybe it's up and over the hammer highs to retrace some of the thin structure and get us closer to 169.50. So that's kind of the move here inside of NVIDIA. I think if it was going to be a short or bearish setup, we would have closed much weaker, closer to the lows, or just more firmly underneath 155.50. Next up, we've got Microsoft. What's going on in Softy and Bill Gates? You can clearly see a little bit of relative strength here as well, just kind of, rejecting right at that level. Don't get me wrong, this is the 261.60, and that was from the closing of the gap, or excuse me, it was really the top of the gap from in here. But it was also the breakdown point, right? If we go to the hourly chart again, this is really coming in handy. Notice that we have that big sort of range candle on the Tuesday session, and then the breakdown is more firmly underneath that level. Poor highs on the hourly chart. You can see all of these back-to-back levels. If it's breached, expecting the move here to 267.25. And again, if we kind of just remain in this, I'm not sure that there's an obvious short in that range. I think the next play would be underneath 250, 250 for rotations into 247.50, so on and so forth. At that point, it's probably also a failure of this trend line that we have coming in from the lows as well. So really, shorts only underneath 250, 250 opens up the door for things that look like this. Last but not least, the mini beast, and then the 3 trade ideas, and I'll send you on your way. Amazon, what's happening here? So here is the range. Definitely not quite at the midpoint, but towards the lower third. Some tricky stuff going on in Amazon, but I would say that this level right here is the short setup. Again, probably better illustrated on the hourly. If we were to come in and breach the lows around 107, we'll call it, just 107, back to the daily. So here, if we take out 107, let me flip tools really quick. Apologies for all the misclicks here on Amazon. But zooming back in, if we take out this level, 107 opens up the door for 102.61. I wouldn't be as concerned with some of these overhead levels that we have on the chart. This is really more of a magnet around 109. Notice that we had support, resistance, kind of magnet, support, support, magnet, and chopping around it on today's session. So I would wait for a push outside of this kind of zone in here. So again, shorts underneath 106, or excuse me, 107, 106.97 is the level on the chart, or longs only if we can kind of get some more firm acceptance above that 112, right? We've been talking about 112 as well from in here. So kind of neutral in this area, and then looking for these places to initiate new setups inside of Amazon. That's what I've got for you in the core list of companies. Let's go back on up to a daily time frame, and we'll take a look at these trade ideas. First one is CSCO for Cisco. What's going on in Cisco Systems? A balance range, perhaps. Let's start from scratch here and draw it in together. Clearly, there are your highs. Here are your lows. We're right at the low end of the balance, and as we were just discussing, this is where your opportunity exists. We have a red-bodied hammer. It's not really the best-looking hammer, but there is a decent-sized lower wick compared to the upper wick here. It's just slightly larger. If we could sort of find an intraday double bottom or an inverted head and shoulders down here at this level, there's reason to believe that we could revert back to the mean, sort of the midpoint of this range. That's a bullish setup, only if the marketplace itself is moving higher tomorrow. If the SPY is ripping to the upside, this is good risk reward on the long side inside of Cisco, right? Stop loss goes just underneath, targeting the midpoint and then the top of the balance in here. That's the long setup. If you think it's bearish, we have seen a wall-to-wall move. Be mindful of that. But if you think it's bearish and we're going to breakdown of 42.70, that's also an entry point, right? Stop goes just above. You could wait for a break, retest, and then go. It could look like a number of things, but I'm just identifying a nice, beautiful balance area here on the daily time frame, offering some setups. Notice on today's session, and really over the past couple of sell-side days, volume has been tapering off, declining here inside of Cisco. Could that mean long? Maybe, right? Maybe if the market's really, again, only if the market's ripping higher, that would be a bullish implication. That would fall into the bull category, give me more confidence to take this type of trade. Next up, what do we see? We've got PYPL. What's going on in PayPal? Zooming in here, a hammer right underneath this balance area, right? So to me, if this wants to come back in quickly, it would constitute a look below and fail. Notice that we have a 100% retracement and extension. So a little bit of a rally here to sort of correct some of that wouldn't be out of the question to me. So breaking up and over the hammer high, looking for long back through some of this structure. Maybe it comes in and targets the top of the range there, closer to 76.83. No trade triggers if we just kind of remain in range or underneath 72. Okay, 72 is your number. number. That's PayPal. Then last but not least is BSX. We don't often look at Boston Scientific because the options aren't great on it, but I do like the hammer candle and bull flag that we saw on today's session. So here is the bull flag, hammer candle printed on today's session as opposed to being relatively weak and closing out as something, horrendous. We also know that this is in the healthcare sector, so it makes sense from a sector support perspective as well. If this breaks out, targets up here, closer to the 50 SMA, I would say it's actually probably maybe slightly underneath, especially for tomorrow's session. This isn't like a big breakout mover. This isn't going to do something that looks like this, but if we see a nice solid session tomorrow, it could come in for the back test of this kind of flush point in here, closer to 39. So watching BSX for a breakout of this bull flag. The trade is invalidated if we take out the bottom end, the low essentially, of today's session. That's all I've got for you. If you enjoyed the video or learned anything new today, let me know down below in the comments section or by giving the video a thumbs up. If you're not tuning into the pre-market live streams, do so. It's a good time. We hang out with like-minded traders. It's great. And with all of that being said, I wish you a green trading week.